All right, I think we are ready for our shortfall risk discussion. So Alan,
Yeah, we're going to bring up staff, Stephen
we've got
and Josh
Stephen.
on PCA.
Josh, our
Get started
rising
out.
star, is coming up.
And I'm going to have Stephen start out with the introduction. So the one thing I will say, I promise not to steal his thunder, is we want you to ask questions and get in a dialogue about this. This is the beginning of, you can fit. This is the beginning of your fall project where we want you to spend a lot of time understanding this, making sure we begin with a common set of understanding, because these are complex investment subjects is critical. So ask questions, interrupt them, and make sure you understand the terminology we're using and the concepts we're espousing. We'll get into it more in November and then more in December or February, and I'll let Stephen describe the next steps.
Chris, were we?
And so Stephen's going to sit back here where Jack does, so we can get everybody up here.
Chris, were we going to have Stephen?
Makita's going to come up after they finish doing their presentation, so they can chime in.
A lot of chairs being. Okay, got it. Okay.
We have to build a bigger presentation.
I know. I think we need a longer bench. All right.
Good morning. I'll begin with just introductions. So today's topic is in your 2014-15 work plan, you identified shortfall risk as the top priority for us to study. So this is the first of three presentations. Before I get into just an overview of how the study will proceed, I'd like to just begin with some introduction. So we have PCA up here, and representing PCA is Alan Emkin, Neil Rue, and John Linder to my right. And then also representing staff is Josh Diedisch. The report in your packet is IMV 251 to 263. And I just want to credit Josh for writing the report. So I think he did a great job. So today's focus is what is a shortfall risk? So we're going to try to define what is shortfall risk and why should we care about shortfall risk. Then as we proceed to November, we're going to do an analysis of CalSTRS or the shortfall risk and how it impacts the CalSTRS portfolio. And also in the November meeting, we'll introduce some possible remedies. As we get into February of 2015, we'll analyze the possible remedies and we'll look at the trade-offs and the pros and cons. So with that, PCA is going to kick off with a short presentation, and then staff has a short presentation, and then we'll open up to question and answers.
All right, Neil Rue from PCA. Thanks, Steve, for the intro. You should have a little PowerPoint in front of you that we're going to walk through. It's not too long. Just to summarize Steve's comments, at the June meeting, you've selected shortfall risk as, Alan put it on the docket, and you guys selected it as your number one priority item, so both staff and consultants are hopefully listening to you and putting it as soon as we can on the agenda to deal with your priority item. So as Steve mentioned, right now it's a project that will probably take 3 meetings. How we're sort of tackling this, what does shortfall risk mean? We want to get the definition right because it's sort of a nebulous topic. After we figure that out, what does it look like with respect to your portfolio? And then finally, what, if anything, can we do about it? And I think that's a fair question because, quite frankly, we might not be able to do anything about it depending on what the goals of the portfolio are. But we're going to explore that. So here's our definition to start off. I'm just going to read it. It says, shortfall risk. The likelihood that a defined benefit pension system will not have enough money to set aside to meet the pension obligations of its retirees in the future. Really goes to there's some gray area language in there. For me, the key words are likelihood and not enough money. And it really goes to the long-term funding health of the plan. That's what we're dealing with when we're dealing with shortfall risk. We have down below here, there's a couple of causes of shortfall risk. It's basically things that unplanned might occur. We sort of break that out into 2 categories. Investment risk related stuff, where we at the table are more experts on than the non-investment risk stuff. But For example, a non-risk investment item might be something like mortality tables being adjusted. That was actually a big hit to you and other pension funds around the country when adjusting mortality tables. That affected your goals in a material way. Those don't happen all that often. They're not as volatile as the investment markets, but they are out there. So when it comes to looking at what might impact shortfall risk, we're going to focus on investment risk. We sort of break that into two categories: long-term investment risk, which we think might, we might not be meeting our expectations, but if it's happening incrementally over time, it's maybe something that we can manage. And then there's short, intermediate term, and when I say short, something maybe within a 5-year period that might happen that really sets us off track. It's not something that happens in a 6-month period, but maybe something anywhere from now to 5 years out that might happen that sets us off our 30-year goal. So that's sort of what we're looking at when you say short-term investment risk. So we've all seen this chart. I think this might end up being one of the more famous charts in the state of California over the next decade or so.
There should be a footnote there with the governor's, that's the governor's chart.
Yeah, there is a footnote there. It's from the statement of Department of Finance. And, we didn't create it, but it basically, we celebrated the fact that this chart, these two lines on the right-hand side of this chart changed yesterday. It's an extremely big deal. Congratulations to CalSTRS for all the efforts and accomplishments in bending that curve. I sort of like this chart and looking at it. I maybe have looked at it a little bit too long, but the bold line that moved down, that was the position that CalSTRS was in. And I think prior to the deal being made, we were all pretty confident that that was the path that this plan was on. So it's bold. It represented a clear path that we were going down. So now we have a dotted line going up. And the basic point that I want to make there about it being a dotted line and not a bold line going up is that this is a plan. This is a deal that was made. And if we go to the next slide, this is an investment consultant's perspective on the budget plan. And we want to be very careful about being investment consultants talking about politics and actuarial items. But in summary, what this says about that dotted line is that there are assumptions that were made that go into that line. And if those assumptions aren't met, maybe that dotted line might not occur. And so that's why we're talking about shortfall risk today. But there are key assumptions, and they probably line up in two areas. It's the fact that contributions are going to double, and hopefully all the stakeholders that are making those contributions will be able to, for the next 30 years, meet those planned obligations. And then the other key assumption, which we're here to talk about a little bit, is the investment rate of return of 7.5%. That's a key assumption that's baked into that long-term dotted line. That's going to be a very tough bogey to meet over the next 35 years. At least that's our perspective. So that's sort of the context.
Just make the 50-50 comment.
Well, yeah,
You can do that now.
yeah, pretty soon. So that's a little bit of the context. So now we begin to shift to focusing really on more that short-term investment risk area. And we have we're basically sort of breaking down what might cause that here on this slide. We sort of have three general areas. Typically, a recession might cause the markets to experience some form of a drawdown or a produce shortfall risk. A financial crisis like we've experienced in 08 and 09. That's not the only time that's happened in this country or around the world. Financial crises can occur. They don't necessarily occur all that often, but when they do, they're really big and they really hurt. And then there are things that we're dealing with all the time. We don't know if they're going to hit us or not. There's a lot of geopolitical and stuff going on right now. They tend to flirt with causing crises in the markets, but then the markets recover. You could look probably at other decades from the 60s or the 70s, and the markets react, but maybe not as permanently to the third item as to the top two. And so out of these three items that might cause short-term investment drawdowns, probably the way we'd rank them is the financial crisis is probably causes the most harm. Then typical recessions with geopolitical, we just don't know how that's going to impact the markets, and sometimes they don't, but they're out there. And I think staff's report and with Makita's assistance, going to go into a lot of detail on sort of analyzing the history of some of those crises. So I'm not going to dwell on that. Here's just one chart that sort of highlights two most recent events. We're all very much aware of them. I don't need to give any deep color on those, and I think Josh and Steve will highlight that. But just the point is just the impact here on these bullet points is that your assumptions say that you need $14 billion to book every single year without stopping in terms of asset growth to maintain your balance against your liabilities. That's the assumption that's baked in, and that's the third bullet there. When these crises hit, they hit really big, as you well know. So if you just go to that second bullet, you experienced a $47 billion loss in the financial crisis period of 08 and 09 versus the desired $14 billion per year gain that you needed to get. So in a sense, that crisis puts you back about $70 billion. So it might be wise to sort of, and that's why we're dealing with this topic, is should we deal with this type of potential event in a different way than we have in the past? And just for the sake of thinking about a normal recessionary environment, that's what the first bullet sort of hits. And even there, you're having through the course of a recession, you might have a $6 billion loss on a $150, $160 billion portfolio. But again, that's against an annual desired growth rate of $14 billion a year. So you can even be, after a 2-year event like the first bear market that we have highlighted on the chart, you can be $30 billion behind, where you should have been booking $14 billion gains.
I mean, two quick things. While you needed that level of return in those periods and didn't obtain it, your liabilities continued to grow. And it's just important to keep that in mind. It's not as though if the capital markets don't perform, the liabilities don't continue on their same trend. And the other thing, and to this I give you the highest credit, most clients, matter of fact, I can't think of another one that have addressed this topic this clearly before it's occurred. Okay, most people are addressing this after the fact, not before the fact, and your being in front of that curve, in my opinion, is unprecedented.
Yeah, I just had Rich.
I just had a quick question. The 14 billion, is that just the internal rate of return, doesn't include the additional revenue coming in?
It's an investment return only.
It's investment return only, not the revenue.
That's right.
Because that's off the current base, not off the future base.
Right.
That number.
Actually,
That number.
that's actually up there on the slide, that's based on the current base. So we have a little bit of a difference between the bases there. So it's even bigger on the current base.
And now I've got
Yeah, I was also confused by that number, and additionally confused when
It's the 7.5% based on the assets. So as the fund grows into the future, it will be more than 14 billion.
That-
It will be 7.5% of 200 or 7.5% of whatever.
right. Okay,
Yeah.
that makes
So it
So
grows
that-
each year. It's
real
not
quick,
14.
there you
Yeah,
go. If
that's-
we hit
that's
200
good.
billion, the number is 15 billion a year.
yeah. Okay.
Okay, so here we begin to just sort of think about the concept of shortfall risk with the context, a little bit of historical perspective. So we have some lines here, and this is called a tulip chart. If you sort of flip it sideways, it sort of looks like a blooming flower, so it's called a tulip chart. But there's the middle line there, and that, as you see in the little footnote down the bottom, this is based on Milliman's, and it's probably I don't know if the Budget of Finance got the model from Milliman when they did the actual model of the plan projections. But this is that same line. That blue line is the dotted line. Okay, so this is the projected funded ratio going forward for the next 34 years based on Milliman's preliminary projections of the budget deal, having the STRS plan and the budget deal all brought into one model. So as it shows, you're going to go from a ballpark funding ratio of about 65%, maybe 67, and you're going to achieve your goal of 100% funding by year 33 or 34. That's what the blue line says. And investment markets, they pretty much introduce the most amount of volatility into achieving that path. And so, as you folks have sort of talked about in your discussion yesterday on the tactical allocation discussion, you don't really want to be reacting and really don't want to get overly tactical because of the noise, because a lot of the noise that the investment markets might present quarter in, quarter out, or year in and year out. So the real question is, it's only probably, as we highlight, we stick a couple of bands around here that are fairly wide. And it's really within those bands you have to sort of treat, and these are sort of conceptual at this point. We'll harden these up, in the next couple of presentations. But, you have a range of noise. And you really don't, your policy is fine when you're dealing with, within that sort of a noise scenario. It's only when you get to the extreme points of that where one might want to think about reacting or think about, well, maybe damage has been done. And so by that little pink or salmon-colored square at the far end out there 30 years from now, that's a place, after accounting for the noise, we really don't want to end up in a place like that. That we would call that shortfall risk because it's permanent impairment at the end of in a sense, at the end of the goal period. Now, there might be things that occurred during that period of time that might have us bounce around, but if we end up there, we have a serious problem. Now, yeah, I think what Alan...
And sometime before then, you had been given information and you would have some ability to try to correct the course. And that's the important thing to recognize, is that you do have to change and react to reality as it exists. Neil calls it noise. I call it reality. And that is, the one thing we know won't happen is that you'll exactly follow that blue line, that you will get 7.5% compounded every single year with no volatility.
Right.
We don't know whether you'll be above the line or below the line or how you'll move, but you won't be on that line.
Paul?
So first of all, on this chart, the title says 75-25 portfolio expected performance, but the key on the right talks about 90-10. So are we talking, is this 90-10 or 75-25?
It's a 75-25 portfolio, so it's a proxy for the CalSTRS portfolio going forward.
75-25 is
The
the
asset
asset
allocation.
allocation,
Right.
and the 90 and 10
Are the
are the
Sort of
probabilities of...
conceptual bounds
Okay,
for the
okay.
range of
So there's a
returns
10
at that, yeah.
So there's a 10% chance we're going to be at the red line, and there's a 10% chance we're going to be at the green line.
Above the green line.
Okay,
Right.
so if we're on the red line, so you're suggesting that we don't really get to the point where we have permanent impairment until the last few years? I mean, why isn't that pink box further to the left?
Well, that'll be the
drop
next-
down.
That'll be the next slide, Paul.
Okay.
The point is, we just don't want to end up. We're saying permanent impairment is we don't want to end up there. After, you've got this goal, this 30-year goal that you just agreed to, that everybody is all on board. It's going to be hard to judge, given the reality that Alan mentioned. Sometimes it'll be a challenge to judge whether or not we're right on top of that goal, a little bit above, a little bit below it. But if we get too far out of whack, and we don't want to end up in that salmon box at all.
Got it. Thank you.
Now, as
Hey, Neil, let me
Alan
just-
was sort of whispering to me, okay,
Can we just butt in,
Sure.
Harry?
yeah,
Thanks, Neil. So the 75% is equity-like
Yes.
exposure, right?
Yeah.
So it's private equity, real estate, and
Yes.
global equities. Okay,
Yeah,
thanks.
very similar to what your
All right,
portfolio
thank
is.
you.
It's basically your policy. As Alan was pointing out, I mean, when we model this, when Milliman models this, probably when Makita models this, we put in capital market. This is based on capital market assumptions, and really what ends up happening is we simulate this to death, going out 30 years, and as you can see, that blue line, about half of the events occur above it, and about half of the events occur below it. So that's, for the sake of a better term, that's about random, the random middle point on the 7.5. It's not like you can be, totally assured that you're going to get your 7.5. It's going to be a tough slog because, there's a half a chance you're going to finish below it and a half a chance you're going to finish above it. after 30 years. But the key, I mean, one thing I want to point out is that blue line represents the schedule that you have towards achieving a goal. So I think this goes to some of Paul's comments yesterday about what he was asking about what will show up in the actuarial evaluation reports, is that this is a funding ratio line. It's not a return line. So you can, in a sense, map or monitor the actuarial progress your plan is making to ensure, year in and year out, to ensure that it's relatively close to this blue line, and or in the near term, if it deviates beyond the red or the green line, that might be a cause for concern. And so that's what we're sort of bringing up in this next chart, which goes to Paul's question. Is there any if we take a look at what's happening in the near term, does that really change the odds about what might happen in the long term? And that's what this project's about. I don't have a hard answer on that. I don't know the answer to that. Mr. Zeiger might say, well, some of those downsides might lead to great upsides, and we don't want to discount that. That is entirely correct. So we have to study the characteristics of those major short-term simulated results to see if they, to see if your policy is unduly biased towards those, and do they push you there, and do other policies lead you to a different place? And the quick answer is, don't have an answer to that right now. Right now.
The quick answer is, wait a minute. Let me have Harry and Tom get in here.
Neil,
Oh, wait, I lost you. Are you okay? You got in there? Let me just get you. How do I, yeah, there we go.
Neil, you said there's currently 50% chance will be above the line, 50% below the line, right? You said
After
that?
30,
After 30 years.
At the end of your goal period. That's
Okay.
correct.
So,
Ballpark.
so is it accurate that the way in which you change that 50-50 split is you'd have to tinker with the 75-25?
You're talking about end game strategies, and I think it really boils down to two things. You're going to be strategic about it, and the answer is going to be yes. You would try to influence the 75-25 mix, and that will, that's a trade-off. That may impact a long-term, might impact that blue line. It might drive it lower, might drive it higher. We don't know that yet. The other question, if you can't do it strategically, and we have to study that, then that sort of leaves you with probably one other option. It's a timing question about being in or out of the markets.
And it's important to keep in mind, we're investment consultants, so we're only going to talk about the investment solution to the problem. The other part is the liabilities, and that's really the jurisdiction of another part of the organization and not part of this discussion, but that's a variable that can also be adjusted over time.
Let me just grab a couple other folks. So, you know what, I can't, how do I get Tom in there without? Where is he in that? I'm sorry. So go ahead, Tom, and then Joy, can you?
Okay, I don't think, I guess I have the mic, so, okay. So one, two comments. One, I'm not sure I tracked what you said about early term results not changing things. If, for example, the first year of a 30-year program, you have a 0 or negative return, I think the way compounding works, it would drive up significantly the return you need over 7.5 to average 7.5. More so than, for example, a 0 return in year 8 or 9. So early term results do matter, I think. Or you might want to comment about that. Then I have another comment.
You're spot on. I think the question is what with your policy portfolio, does its behavior in the near term look any different and drive you towards different long-term outcomes than maybe some other asset allocation does?
Yeah.
And I don't have an answer to that right now.
Okay.
And Tom, Chris wants to jump in before your
Yeah.
next question. Chris?
No, after Tom's done, I'm sorry.
Okay.
No, go ahead. Comment on that, because my other comment is quite different.
Mine was actually a global comment. The audience, I'm getting questions. These slides were supposed to be in the packet. I apologize, we messed up and didn't get them, but they will be available to the public after the meeting on the .com, CalSTRS.com website. So these are publicly available, and I know they're very hard to see.
I'm sorry, they're already there.
They're already there. Never mind. They're already there. So those with Wi-Fi, you can see the slides now.
Yeah. So my other question is, as we're looking at this as a topic, and I know we all said this is the big issue that we have to be mindful of as trustees all the time. I'm not sure what we're driving at that's actionable at any point in time or now. I mean, basically what you're saying is markets go up and markets go down, and investment results will vary, and we have to react. I mean, is this leading to anything that's actionable?
Tom, the answer is absolutely yes. And the question then becomes, do you want to look at different investment strategies and even possibly different asset allocations, which would create a different return pattern? And that's what's going to be explored, not asset allocation per se, but different investment strategies, which give you a very, very different risk-return pattern and aren't as reliant on the equity risk premium as your current portfolio.
Well, so just to put a point on it, staff has just done this phenomenal job negotiating basically a deal with the government, with all aspects of the government and our stakeholders that sort of turns on an asset allocation that assumes a 7.5% return. And for us to come back and say, now we want to reduce the risk, shortfall risk, and we'll change our asset allocation to a 6.5% return, I don't know what would happen to us, but I don't think it would be pleasant.
Well, I mean, that goes to the, you know, what I said before is, I don't know if there's a, you know, we're going to go through this exercise, but you may end up choosing to be just to hold pat. Because it's going to be a very difficult exercise. You know, it's going to be very, very difficult to find something that, you know, keeps you at a 7.5 and cuts your risk in half. That's not going to, it's going to be a challenge.
Yeah, I mean, so I guess the point of my question is, is this a backdoor way for us to revisit asset allocation before the next
No.
study?
No.
The answer
We
is
have a-
absolutely no. I think what it is a way to review and consider strategies that really weren't part of the previous asset allocation that focus on downside risk.
And that may be, you may want to consider to put into the strategic allocation. And to go to your points about what you were making in some of the other sections is, if there's something that pops up here strategically, it's going to have to be big. You know, you're going to have to move the needle on your portfolio, and it's not going to be a $2 billion experiment. It's going to have to be a $20 billion, you know, $10 or $20 billion commitment strategically to do it. So we'll get to that in the
Every
next
3
couple
years,
of sessions.
Yeah, it's part of our policy to revisit that, so we will get back there again when we
Yeah.
do our next asset allocation.
So I think that, you know, as I wrap up with just a final couple of slides, I mean, that hopefully okay, I'm sorry.
I just want to kind of comment on what Tom said and Alan's answer, because I think the question isn't that we want to change our asset allocation to get a lower return. Part of the question is, what happens if our asset allocation doesn't return 7.5%?
Yeah.
You know, so we haven't changed our asset allocation, but it turns out the world performed differently than we expected, and we need to be monitoring that, and we need to be having an ability to think about a way to react to that, and we also have to. So I think that's the other side of it. The one side is to think about additional strategies when we go through our next asset allocation effort. But the other side is to be aware that maybe we have to react to the world turning out differently than our assumptions. Hopefully that doesn't happen, but you know.
Well, yes, certainly we have to be mindful as we move in time about what our real returns are as opposed to the curve and what it does to the curve. I agree with that. And certainly we're in an interesting time right now because we have outperformance and negative cash flow, which creates some interesting strategic questions. The question I thought this study might lead to is, what do we do with outperformance? Do we put it into more inherently conservative things? Do we use it to cover negative cash flow, or do we say, okay, we've got outperformance, but it's going to average out over time? And I thought that's where you were going to lead, but I guess not today.
In fact,
That's a great
that's
question.
one of the issues that will be raised in this process. And we were discussing that just last night, is what do you do if you have a series of really good years? Do you try to immunize part of your liability to reduce risk that way? Do you double down your bet? And that's going to be part of this process.
I think that's very interest rate dependent, is what Chris will tell us.
All right.
Okay, I'll just wrap it up and then I'll pass it over to Josh and Steve so they can give you a little bit of background. But you know, just the summary comments are you've made some big reforms. They've addressed the long-term solvency issue of the plan. If all the assumptions are met, and that's a huge victory for this plan, and you're to be congratulated for that. Number two, we have to think about the long-term result. We have to think about our long-term goals and can we get there? And we just are operating under this, we're thinking about this idea of, well, maybe the long-term results might be dictated about what happens in the next 5 years. And should we seriously pay attention to that? Because, if something, within the next 5 years, and we're not talking a 10% correction, but if something happens like somewhere between a 2002 and a 2008, just come up with something in between that. If something like that happens, it's going to be dire for this plan. So we're trying to be proactive about that. And then I think the final comments here, going to Tom's point is, we may go through this whole exercise and we may realize that any strategic change may dampen the long-term return too much and the trade-off is just too big. So we might just choose to stand pat, and that's going to be, just where we end up because there's really no solution that can get us there. But we'll just have to go. We just want to go through the process, and we'll begin to study that in November by just sort of trying to put some more take your portfolio and try to quantify it a little bit more about along the lines of the charts that you've just seen. And with that, I'll unless there's any other questions, I'll pass it over to Josh and Steve, and they're just going to give you, I think, a little bit of historical perspective on how some of the classes behave and how the CalSTRS portfolios behave, just to give you a little bit more meat to the bone, so to speak.
Let me let Tom talk, but let me just do a time check really quick because it's 12 o'clock. So what are you guys thinking about in terms of time this is the second part of the presentation, and is that
Yeah, there were two
after
parts.
Josh?
My part should be 10,
Okay.
my comments are 10 minutes.
Okay.
Maybe a little less.
So I
a little more.
think we're sort of looking at maybe taking a lunch break at 12:30, being done 12:30, and then I think we're going to take a short lunch, like half-hour lunch. So just to give, I know members of the audience like to plan for lunch, so I think that's going to be the plan, is aim for 12:30 break, and then we'll come back at 1 o'clock for a half hour. So let me grab Tom.
30-minute duty free.
30 minute.
So actually, it'd be an interesting piece of analysis for the next time to look at what the cash flow returns are required to get us to fully funded as opposed to assumed investment returns. In other words, take into effect the negative cash flow we have for the next 5 or 6 years. Does that drag on our probability of being fully funded? I can't mentally do it, but I could see an argument being made that actually in this period of negative cash flow, we need more than 7.5% in investment return to build the fund to the level that we need to be.
Well, the projections that were made were familiar with the cash flows, because these are coming from the actuaries, so I think that's net numbers that we're looking at. But the fact that if there is a big negative event and you have significant negative cash flow, it makes it even that much more difficult to climb out of the hole.
Yeah. Well, anyway, it'd be interesting to look at, because
Yeah, I mean, again, I agree. I think it's not only interesting, I think it's essential, because, I mean, we could be in a position where we're, long run, our actuarial valuation is sufficient, but along the way, we just didn't have enough cash flow. I mean, when we have $14 million of investment return, that's not billion. That's not 14 billion of cash flow. It could be, a lot less. It could be more, depending on, if we have liquidation events and things like that. But I mean, on average, I mean, what is, given the way we operate now, and the asset allocation we have, if we get 14 billion in return, how much cash flow are we actually expecting that we would get? Do we have any idea what that is?
That sounds to me like an information request for
Okay.
next time.
Oh, well,
Is that-
but I mean, I
can
think
interpret-
the analysis,
It sounds like
I think
there's
the
desire.
shortfall analysis has
Right.
to incorporate
Yeah, we can figure out
cash
that
flow
there's an
analysis.
income.
Yeah, great.
Back to the thing I said yesterday, the private equity and real estate are too lumpy.
Right,
We can
right.
figure out capital gains appreciation. That's what makes up the bulk of over 5% of the 7.5 has to come
Yeah.
from capital asset appreciation.
Yeah.
And, some of that stuff, we never sell it. We just market to market all the time. But the cash flow dividends income is fairly small.
Just waiting for the presentation to come up there. But basically, I just wanted to take a few minutes just to summarize some of the couple of main themes that we have in the item there. Neil touched on this a little bit already, but really the first section of the paper, the first theme really is about how risky assets tend to go down together in bad economic times. And it's something we're pretty familiar with, but just really sort of documents that across different events and for different asset classes. And then shows a little bit about the length of time that it takes to recover from some of these events. And the first chart that I'll show you, the next slide, will get at that question a little bit too. And then so that's the first theme, is really about how these assets move together. And then the second theme is really about the sources of historical returns, really what's driven returns across asset classes, and really documents the importance of income and yield and reinvestment for historical returns across asset classes. And so it gives us some information, and we can look at current yields in different asset classes, and we'll do that for fixed income and for equities, look at those yields and valuation levels and what those mean for future returns. So those are really kind of the two big themes that we're trying to, the message we're trying to get across in the item. So this first chart really gets at the question of how long it takes to recover from some of these different events. And so the way we approach that is through this representative portfolio. And this is similar to what Neil showed you. So for the 1973, for the oil embargo, and the 87 event, we use a portfolio of 70% equity, 30% intermediate treasuries, and we track the performance of that. And then for a portfolio for the dot-com bust, we have actual CalSTRS data, and so we can look at that and see how that performed. And so what this chart really does is it puts these events on a common time scale. So they all start at the market peak, basically right before the decline. So using the 87 example, it basically starts in August of 1987, the peak right before the market decline began, and tracks the performance of that. And we're looking at it versus that dotted line, which is basically if a portfolio continued to just earn 7.5% annualized, how would that portfolio do? And so we can get a picture of how long it takes to recover back to that line. So for the 87 example, it was pretty quick. You see a pretty sharp, short decline and a recovery, recovered to the 7.5% in a couple of years and dipped down back below, but was really pretty much permanently above that at that point. But when you compare that to what's happened since the dot-com crash, you see a little bit deeper, more prolonged decline, and the portfolio slowly recovers and very nearly recovered to the 7.5%. And then we get hit with the financial crisis and sort of sets it back on a negative path again. And I think that's really highlights the key risk that we want to talk about when we talk about event risk is sort of the combination of either an event that's so significant that it puts you on a path where you're underperforming for an extended period of time. So we're 14 years out, a little over 14 years since the dot-com bust, and we haven't recovered a 7.5% return. So that's the first thing. And then the second is really this idea of getting hit with a succession of events that even you may be partially or almost all the way recovered, and you get hit with a second event, and it puts you on a path where you could be below your expectations for an extended period of time. So that's really the story we're trying to tell with this chart.
Just one question. This is of a representative portfolio. Is that a 75-25 portfolio, or what do we mean by representative?
So for the oil embargo in '87, it's a portfolio of 70% equity and 30% intermediate treasury. So a good representation of an institutional portfolio, similar to what you saw from Neil. It's a good proxy for how an institutional portfolio performs.
So for all of these, that's
With the .com, we used because we have CalSTRS data. If we had CalSTRS data for the prior events, we would have used that, but we don't have it. So we needed
our actual portfolio.
Correct. Okay. So the next chart gets at a sort of the second part of the item, which is looking at the relationship between yield levels, current yield levels, and subsequent returns. And so what this shows you, each of those dots is a 5-year, representative of a 5-year period throughout history. So the horizontal axis is basically what the yield was on the 10-year treasury at the beginning of that 5-year period. And then the vertical axis is what the subsequent 5-year return was. So you start at a point in time and you have a yield, and then we look at how that asset did for the next 5 years.
So Josh, is that the return of a treasury or the return of the portfolio?
The return of a treasury. So each one of those dots, if you invested, tells you at the beginning of the 5-year period what the yield was on the 10-year treasury, and then had you purchased that and held it for 5 years, it tells you what your return your annual return for those next 5 years. And so what that's really getting at is this question of, you've heard it from Alan and others about what your expectation is to earn on fixed income assets, and this gets at the question of how predictive the current yield is of forward-looking returns. And so it's a pretty good fit. So we put all those dots on there and then fit a line through, and we can show sort of where we are today, which is the current 10-year treasury is somewhere around 2.5% plus or minus. And so as you go across the bottom, you get to the beginning 10-year yield. So it gets you to an expected return of something around 2.5%. And I think that's consistent with things that you've heard from others and consistent with what you see in the capital market assumptions as well. Okay, so the last slide we have does something similar. So what we do is for the equity market, again, look at 5-year periods. And instead of looking at yield at the beginning of that 5-year period, we look at the price to earnings ratio, the PE ratio. And it's a good measure, and Chris talked about it in his item, it's a measure of how rich or cheap equities are. So we use that and then look at how at the nominal return, the 5-year annual return from equities from that point on. So, and in this case, we use, you'll see people use different measures for PE. This is a little bit longer term view. It uses smoothed earnings. Earnings tend to be really volatile through the business cycle. So this looks at the smoothed earnings and then the current market value of the equity market. And so we put all those dots on there and then fit a curve through there to kind of get a picture of what the historical relationship is. And on average, what you see is kind of what you would expect, which is when valuations are lower at the beginning of that period, you tend to see higher subsequent 5-year returns. And then on the other hand, when valuations are higher, when they're rich, when equities are rich, the subsequent 5-year return tends to be a bit lower. And so one actually interesting dot on there is the one we highlighted, which is 96 to 01. Probably it's the most extreme outlier. Then when you move all the way to the right, the next 5-year period, 2001 to 2006, is that dot that's all the way out on the far right, just past 35 on the beginning PE. So you sort of see a little bit of that movement from the most extreme. So, yeah.
Thank you. You answered part of my question. I was going to ask you what the two dots on furthest right and furthest left were.
The furthest left, I'd have to go back and look. I'm not 100% sure. That may be right after the Depression, but I'd have to actually look at.
Or
go back
82.
Yeah,
Yeah.
could have been. I'd have to look at the data.
All right, thanks.
Maybe the only one, but can you tell me what 96 to, the dot 96 to 2001 is telling me?
So that is telling you, so in 1996, the PE ratio measure that we're using was at about 25. And so what that dot tells you is the PE was at 25, and then in 1996, from 1996 to 2001, you earned an annual return of about a little over 19% per year.
So it just highlights what an aberration that environment was, that you started the period with really high PEs. You would have expected a low single-digit return, but that was the, go-go time of the internet and people paying up. I remember that time period is, if a company had a bigger loss, the stock went up even higher. And remember all the, old J.C. Penney's and all those box stores are going to be out of business, and we're all going to be doing everything on the internet. So Amazon was rising that entire period and losing money as fast as they could, and it was amazing. But so a very unique, aberrant period. And then, as Josh said, the other one on the other extreme, when PEs rose all the way up to almost 37, 38, then you did have what you would expect, which is that 5-year period had no return. So the buying point, both of those slides emphasize, as we always say in staff, price matters. Your entry point matters a bunch. You got to buy low and sell high. The very far one out, the last dot on the right side between 35 and 40, and it shows you that there was a zero return for that 5-year period. So we started 2001 with very high PE rates, and sure enough, got no return on stocks.
They were the highest ever, I think, in 2001.
Yeah.
And then there was a 5 or 10-year period of zero over 10-year period.
And contrastly, as they were pointing out on the left-hand side, I think Neil's right. You've got probably 1930 in the Depression when PEs were at 5 or lower. The next dot is probably 1982. I remember PEs were around 7, 8%. Very, very cheap, and corporate earnings then came in.
Tom?
Oh, I had a comment on the same thing. My guess is if you had successive 5-year periods, 96, beginning 96, 97, et cetera, and you'd see that the drop off from 2000 and 2001 is very dramatic, but yeah.
If you put all of the 5-year periods, all the overlapping 5-year periods, you get a massive dots that have pretty much the same shape. They sort of cluster around all those points.
But yeah, but the returns from, maybe it's the returns on the 5-year period, 95 to 2000, would be very high.
Correct.
And, yeah.
Paul?
And just another comment, Amazon is still spending money as fast as it can. And J.C. Penney's is still going out of business.
Times haven't changed that much. Huh? Paul?
So maybe you're about to tell us this, but where are we today on this?
So I'll bring that in right now. So there we are today.
Okay.
So right around
This is like
26. And so that best fit line through the historical gets you to about an expected nominal return of about 4.5% a year is what that would tell you. And there's a, we put the shaded range in there because it's a noisy estimate, but that gives you a decent approximation.
So this is telling us that equity returns over the next 5 years based on this would be about 4.5%.
Correct.
And our capital market assumptions for which I understand are for 10-year return are what?
875, Jim? I
875.
think 875.
So about almost twice what this is telling us. Okay, thanks.
And that's really the part of the message here is that you have, this idea of time varying returns that at different points in time, depending on where prices are, you'd expect different levels of return.
Harry?
So
This might be belaboring the point, it might be a little bit off topic, and if it is, I apologize, because we're right before lunch, so, for no other reason. It would be interesting to see if you looked at like a 20-year period from the beginning of a decade of zero, over a 20-year period, where would you be 20 years out from where the first year of the decade of zero began, if you assumed a 7.5% of return? So you went 10 years with zero, where does it, and then you ran another 10 years. But if you assume 7.5 for that 20-year period, where you started at the beginning, where would you be after 20? Does that make sense?
So doing that with the actual history, or just sort of simulating
Simulating.
Yeah, I mean, if I'm understanding the question right, so it's basically looking at what you would need for that back half of that time
Correct.
period to get
Yeah,
to
for
that
the second half of the
7.5%.
game, for the
Yeah, that's
second half.
that's something we could do pretty easily. Sure.
That gets at a real important point is we often talk about arithmetic averages, and yet we live life geometrically, as Harry is pointing out, year by year in a consecutive order. So we say you're going to earn 7.5 on average over a 20-year period. You can still end up with, as you know, and Alan just presented this morning, we've earned 7.7% for the last 10 years. And I remember Jack asked me the question, well, wait a minute, if we've earned 7.5 for the last 10 years, why did the unfunded liability grow? The liabilities grew, but it also was a geometric pattern. Think about the fact that we had a 25% loss during that 25-year or 10-year period. It happened when the portfolio was at its all-time highest. So it was 25% off a big number. The rest of the periods we earned 20%, but it was on a base of smaller numbers. So the average is 7.7. The growth of a dollar chart, as you know from the actuary, we didn't meet the funding. So the other thing I'd point out real quick, just so you know, this is the Robert Shiller, the Case-Shiller PE ratio. As Josh said, it's smooth, but it does say the same thing. The valuation chart I showed you, where I said the PE was at about 13, different methodologies on calculating the PE ratios, but they tell you the same thing. Think about that valuation scale I showed you. The U.S. is in the yellow of being, very fully valued. And that would imply you'd expect lower return going forward out of stocks, because you're not going to get PE expansion. People aren't going to become more optimistic. You're having to wait and hope that corporations grow their corporate earnings in order to make your return.
So
that was it. That
Okay.
was all I had. So I guess we just wanted to summarize what was in the item for you, and then answer any questions you might
Starting
have.
point matters.
Starting point matters. That's right.
appreciate it. Thanks, everyone. I think for the next presentation, we'll make sure we have a seat for Makita. Did you want to comment at all, Stephen or Makita? Or?
No, I didn't hear everything.
Okay, great. Thanks so much. Appreciate it. I think what we'll do is because I know there's teachers in the room, and I think we're going to just finish the open session agenda, because we have the responsible contractor policy, item 13, with Mike and Greg, and then just a few pieces, and we will close open session after that, let folks go off and not be stuck in traffic, and then go into a closed session to finish up our day. Hi, Mike. Hi, Greg.
record, Mike DeRay and Director of Real Estate, Greg Madden, Portfolio Manager. Greg and I have been working on this item, but really the whole staff works on responsible contracting on a regular basis. It touches all asset classes, and although Greg runs the retail portfolio, he has done a significant amount of work on responsible contracting, even back to when we both worked at CalSTRS and drafting various versions of their documentation and the versions that we've done here over time. This particular, we have not had an update to the responsible contracting policy for over 10 years, and the reason for that is, as it says in the item, it's been fairly successful. We've been able to expand the use of the responsible contracting policy throughout with new managers and throughout our joint ventures as well as our direct holdings, and that's outlined here. The update we're doing to our policy is a number of steps, and I'm going to let Greg talk about how we're going to go through our update.
Thank you, Mike. As you read in the agenda item, our policy has been in place since 2004. As Mike indicated, I used to work at CalSTRS and was on hand and helped assisted in the original drafting of the original policy, which I believe was 91 or 92. And when I joined CalSTRS, Mike asked me to write a policy for us. So it's been 10 years. It's time to revisit it. And as Mike said, we're very encouraged. I think the policy's been pretty darn successful to date. We've been successfully encouraging our business partners to utilize prudent business practices. And we've been, over the last several years, and our new numbers are in just for the last fiscal year, we now have about $1.2 billion of work that's been completed on our real estate portfolio, and that's about 99.7% compliant with responsible contractors. Over the years, we've had infrequent conversations with organized labor over specific projects, which has generally resulted in good results and improved communication. And to date, we've only had 2 formal complaints, which are actually about the same project. For the review that we're planning,
Greg, can I just, what was that project?
it's the bricklayer issue.
Oh, the bricklayer, okay.
Yeah.
I'll go.
For this review, we have and are planning to conduct conference calls with the stakeholders. We're going to have calls. We had our first call with organized labor to seek their input. And on Monday, we'll have a call with our business partners reflecting on what we heard in the labor call to understand that. Have a follow-on call with both organized labor and in a separate call with our business partners, and then come back to you in November with a first draft of a policy revision. And I'd like to share with you that in that first call we had with organized labor, the general comments were they really like our policy for the most part. They see some issues that, some points that can be tweaked, but overall, the general commentary is it's a pretty strongly written policy. The concerns had to do more with the implementation and how we can better foster communication with our business partners. So that will be, I think, a key topic going forward that we discuss with our business partners. Also wanted to note that this policy is going to be expanded across other asset classes beyond real estate. Notably, it'll be inclusive of infrastructure. And with that, if you have any questions at this time, we'd be happy to answer them.
I have a couple. Do you want me to go first, Chris? And then, okay. So when they talk about when stakeholders kind of brought up the implementation issue, can you talk a little bit more about specifically what in the implementation has been an issue or sticking point in terms of, my assumption is it's applying the policy in real situations like the LCOR situation or other, what were the implementation issues they brought up?
Actually, we'll touch on the things, and some of these are just what's happened over time. I think we can do a better job in laying out how a complaint process can be handled. When looking at other policies in the marketplace, there is one other one. PERS actually has a very detailed complaint process. And looking at that, I think that we could kind of move towards a more detail on how someone can raise a complaint and raise issues with the policy. So that'd be one that we haven't just heard recently, but
there has been things over time of even finding the policy. It wasn't even on our website in a place that could be found quickly. And so things like that are just from an implementation standpoint, we can do a better job of.
Let me just, so we're talking about like at our excuse me, CalSTRS.com website, like under investments or something, being able to have a really easy to find place where the policy is placed, and then there's like a grievance process or a complaint process that's people can click on and easily, is that kind of what you're talking about? Okay.
I think that's on the front, the back end that Mike's addressing. On the front end, I think the implementation, and so Mike's correct, I think to amplify on that a little bit, it's better notification when work becomes available. So I think on the front end, there was some concern about, how adequately folks and how much advance notice they have on projects that are coming down the pipeline. So a lot of that will be, I think, on our outreach efforts and our business partners' outreach efforts.
Actually, add one other thing that has happened over time. When the policy was first put in place, it was more typically set to the service organizations that do work at our assets, so typically our office assets, and was geared towards the services such as janitorial services, because those have been the issues that we had. We didn't have a lot of construction in our portfolio, and over time, as we've been willing to do more construction, those trades are trying to apply a policy that was really more focused on service. So that's some of the other changes we're doing is to bring in the construction aspects of doing fair wages and benefits on the construction side, which the policy generally covered, but I think we can do a better job of a specific focus.
Another issue I hear about is the subcontractor issue, sort of implementing so we can implement our policy over folks we're contracting with, but then we have, subcontractors and subcontractors, and making sure that policy, is that something that is being addressed?
That's part of the outreach that I addressed previously, is making sure that filters down all the way down.
Chris, did you want to chime in, Chris?
I just wanted to ask, just for the board's sake, did you count how many unions were on the call or the number of participants on the call?
Gene, did we count?
We didn't count organizations, there is at least 12 to 15 participants.
So, but yeah, 12 to 15. I was on the call. We had a big staff here at CalSTRS that listened, and it was a go-to meeting, so they could go through some PowerPoint presentations for everybody. But so 12 to 15 groups, people on the call. It was a good cross-section of the construction trades, and then definitely the two major service unions were on the call as well. So I think we had, the important point you had told us was to make sure the stakeholders had a voice in this, and I think this initial call was very successful. And as Greg has said, policy is fine, it's how it's implemented, and those are the things we've got to address. So we'll do another follow-up call, and we emphasize to them the first reading will be in November, and it will be just a first reading. So if they don't like it or they want to see things, they'll come here in person and let us know, because they wanted to make sure they understood the process and that it was transparent. It was a big issue for them.
And I assume we track when we have complaints or issues from these different groups, that we track who those people are, and we've tried to include them in these conversations moving forward. Is that just because
every group that we've had a conversation with respect to the responsible contract was invited to participate over time, has been invited to participate in these calls. And as they were naming themselves, I don't remember someone that over time we've spoken with that wasn't participating in the call.
I would say the one comment I'd make, Mike, is we tended to reach out, and the people we heard were from the national unions. Oftentimes, some of the complaints that come to you or come to the meeting are from a local. There were a couple of locals on the call, but mostly it was the national people. They were, because it's just a more efficient way to get their picture on it.
Thanks. I don't see any other questions from board members, so thanks, Mike and Greg. Appreciate it. Our next item is a review for information requests. Jill, do we?
Sure, we had quite a few information requests, so I'm going to try to do this best I can. I think,
and we asked Chris on all the things that were over my head to please help us out and reiterate.
I might need some clarification on a couple of them.
Okay.
But so the first one is you asked PCA to bring back statistics on how new private equity benchmark affects the calculation of the performance statistics on specifically on INV 27. So I think you wanted a recalculation of that. Second one was to quantify in dollar amount the outperformance in relationship to peers indicated on INB 27. The third one was information on what the capital market assumptions were for each asset class to show a comparison in the chart as well. 4 was information on cash flow returns required to account for the negative cash flow. Any more clarification or is that right? Okay. And the last one, this is the one I might need help on. What is needed to get, I think the question was, what was needed to get to the 7.5% factor over a 20-year period in the event that the first 10 years or so do not meet that expectation? Is that what you meant?
So the way I'm going to interpret that, you're asking us to compare arithmetic returns and then show some examples of some geometric returns and what happens if you have a zero return at the first part of a decade, and then what do you need in the second half, or you have a loss at the beginning of the decade. How does that look to average 7.5 over a 20-year period?
Yeah, I think we're on the same wavelength. It was basically the effect of compounding when you miss at the beginning. And it wasn't 10 years, it was 1 or 2 at the beginning. I think makes the results very dramatic.
And that was it?
Great, that's it. Okay, thanks, Jill. All right, item 15, draft agenda for our November meeting. Chris, are there any changes? I think we're, yep, go ahead.
Just to let the committee know, Sharon and Paul had asked that we consider having some guest speakers, educational speakers come in. We've already lined up, thanks to Jack, Al Gore, and David Blood. You're going to hear David Blood at the offsite. There are sustainable manager generations, but you'll get what we like to call, or what they like to call, the Blood and Gore show in February. And they will come in and talk about climate change and sustainable managers. But Sharon had asked that we reach outside our network of managers and try and bring in some interesting, educational, thought-provoking speakers. The investment committee has done that in the past. Back in 03 and 04, we had speakers come in and talk. We'll try and limit them to about 30, 45 minutes. My hope is that we'll be able to get somebody already lined up in February. Jack has been working on Tom Steyer also as a speaker out in the rest of the year. So we'll try and bring some people in to challenge you and stimulate your thoughts on investments.
All right, and our last item, 15A, is opportunities for statements from the public. I didn't receive any. Okay, well, with that, we are going to adjourn the open session for the investment committee. So teachers, enjoy the rest of your weekend.